Okay. So in the last class, we discussed accounting for financial asset. So how the financial asset is recognized, the two equity instrument. So just I will revise once. So in case of equity instrument, those are recognized in two ways. One is by using default approach, and another one is alternative approach. So then what is the at what cost it is recognized, at what price it is recognized initially. In case of default approach, it was recognized at market value or fair value, and here it was recognized at fair value or market value, plus we have to add what, transaction cost. Okay. And coming to the transaction cost adjustment, and here it was treated as an expense and transferred to profit and loss account. But here that amount is capitalized and is added to the cost of the respected investment. Clear? Next, any dividend income, any dividend income that is recognized in P&L, and here also recognized in P&L, and fair value gain or fair value loss, and that was transferred to so fair value gain or fair value loss that was transferred to profit and loss, here recognized as other comprehensive income, other comprehensive income. So these what we discussed, and the related problems we discussed in the last lecture. Next, coming to the financial asset. Financial asset, debt instrument or debt investment. That means what? We may purchase the debentures, bonds, or loan notes of another entity. So here the amount invested in the debentures or bonds or loan notes of the another entity, then those are covered under debt investment and are treated as what, financial asset. Financial asset. So in this case, there are three ways recognition. There are three procedures are there for recognizing the debt investment, and we may follow either amortization, amortized cost, and fair value through other comprehensive income, and fair value through profit and loss. So fair value through other comprehensive income and fair value through profit and loss. Then before that, for recognizing the respected financial asset, the two debt investment, So we have to apply the two test. We have to consider two tests. So that is, the first one is what? Business level test, and another one is so the first one is what? Business level test, and another one is what? So contractual cash flow characteristics test. Cash flow characteristics test. Okay. Then when we consider amortized cost and fair value through the OCI and fair value through the profit and loss. So just we will verify. So these two tests required to be applied. One is business model test and another one is contractual cash flow characteristics test. Contractual cash flow characteristics test. And how we consider these two tests are applied. When we consider amortized cost, when we consider fair value through the OCI, and when we consider fair value through the profit and loss. For example, A Limited purchased debentures of the B Limited. A Limited purchased debentures of B Limited. So for example, if A Limited wants to hold the respected debentures till the date of maturity. So if A Limited wants to hold the debentures till the date of maturity, then we follow the amortization cost. Means that A Limited has no intention to sell it, because in case of debentures or in case of any debt fund, those are repayable after some period, right? So if the buyer hold the investment, till the date of maturity, then we apply what? Amortization cost. So hold investment till the date of maturity. Hold the investment till the date of maturity, then we apply what? Amortized cost. For example, if the investor wants to hold the respected investment till the date of maturity, but if any better price offered in the market, I will sell it. For example, debentures are redeemed by the B Limited after 5 years at $50 per debenture. But for example, the total maturity period is how many years? 5 years are there. But within the 5 years, I have the better offer more than $50. Then I can shift. For example, if I wanted to hold it till the date of maturity without inquiring about is there any offer available for the debenture in the market, then just go to amortized cost. So if the party wants to hold the investment till the date of maturity, plus and those are sold by the party if better offer is available. In the market before maturity. Clear everyone? If A Limited wants to hold the investment till the date of maturity, then better to go for amortized cost. And along with that, if the party wants to sell it, if better offer is available in the market, then that is covered under fair value through other comprehensive income. And the last one is, if the party hold the investment for trading purpose. The party hold the investment for trading purpose. Then we classify it as fair value through profit and loss. Fair value through profit and loss. So these are the three methods available for recognizing the debt investment in case of financial asset. In case of financial asset, what are those three models? Amortized cost is there. Fair value through OCI means other comprehensive income. Fair value through profit and loss account. Fair value through profit and loss account. Is it clear, everyone?
Yes, sir.
Any doubt? Any doubt, Sama?
No, sir.
Then what is the accounting? And coming to the cash flow characteristic test, just we need to verify the cash flows relating to the respected debt instrument. Generally relating to the debt instrument, two types of the cash flows are available. One is regular interest or dividend, if any. In case of redeemable preferences, we expect dividend. And at the date, on the date of maturity, the sale price, and we say it as fair value on the date of maturity. So these two are the cash flows relating to the respected instrument. These two are the cash flows relating to the respected instrument. Then coming to the accounting treatment. Coming to the accounting treatment, in case of amortized cost and fair value through other comprehensive income and fair value through profit and loss. Fair value through profit and loss. Then coming to the first one, interest income. Then how to recognize the interest income? Interest income is always recognized at effective rate of interest. And generally there are two rates are there. One is coupon rate and another one is what? Effective rate. So coupon rate is applied on the face value or par value of the respected debt instrument, but effective rate is always applied on the investment. It is always calculated on the invested amount, nothing but market value. So interest income is always recognized based on effective rate of interest. In three cases, effective rate of interest. Effective rate of interest, we have to consider it effective rate of interest. Then coming to the second one, and what is the initial recognition? What is the, at what price we have to recognize? So initially we have to recognize it at purchase price plus transaction cost. Remember, the transaction cost is required to be capitalized in case of amortized cost and fair value through the OCI. But the transaction cost required to be expensed in case of fair value through P&L. So in case of fair value through OCI, here also purchase price plus transaction cost here at purchase price only. You have to recognize at what? Purchase price only. Next, coming to the transaction cost. Transaction cost is required to be capitalized. So what is meant by capitalized, sir? Added to the cost of the asset. Added to the cost of the asset. So here also what? Capitalized. But here it is required to be expensed and transferred to statement of profit and loss. Required to be expensed and transferred to statement of profit and loss. Statement of profit and loss. Next, fair value gain or fair value loss. Fair value gain or fair value loss, and fair value gain and fair value loss, first of all, here not applied and we does not consider, because and we have to calculate what is the carrying amount based on amortized cost. What is the carrying amount based on amortized cost? Every year some portion of the asset is amortized by transferring to the P&L. So that's why no fair value is considered at the end of the every year. Fair value is considered only in the second and third method. In case of second method, so that increase in fair value is transferred to the other comprehensive income. But in case of fair value through the P&L, that fair value gain or loss is transferred to the statement of profit and loss. Statement of profit and loss. Next, disposal gain or loss. So disposal gain or loss is always transferred to which account? Statement of profit and loss. Means if the investment sold during the period, at the time of sale any profit or loss is created, that is transferred to which account amount? Statement of profit and loss. Statement of profit and loss. And so subsequent recognition in the balance sheet. In case of amortized cost, it is required to be recognized as per table. It is required to be recognized as per table. So what is meant by table? I will explain. But in case of fair value through the OCI and fair value through the P&L, that is recognized at fair value at the end of the every year. And the difference, if any, is treated as fair value gain or fair value loss, which is transferred to other comprehensive income or statement of profit and loss, depends upon the case. So these are the points required to be considered in case of debt investment relating to the financial asset. Is it clear, everyone?
Yes, sir.
Then here, amortized table. How to draft the amortized table? So table relating to what? Amortized cost. 1 minute. So amortized table. So table relating to what? Amortized cost. So here we have to consider here opening balance Here opening balance and interest income. Here opening balance, one minute. So here opening balance, interest income and amount received, closing balance. Amount received and closing balance. So this is the table. So generally in here opening balance indicate initially, for example, here indicate what life of the respected debt bond, for example say 5 years, and initially we start with what initial cost. In case of amortized cost we consider purchase price plus transaction cost if any, and in case of fair value through the OCI, we consider purchase price plus transaction cost. In case of fair value through the P&L, we consider purchase price only. Transaction cost is not capitalized there. Next, interest income is calculated at effective rate of interest for any classification. If you remember, for any classification, those are calculated at what? Effective rate of interest. And here amount received. For example, coming to the debentures, we purchase the debentures of the company, and the company, as per the debenture certificate, company agreed to redeem the debenture after 5 years. Company agreed to redeem the debentures after 5 years. After 5 years. Okay. Then in the first year, we received what? Interest income. In the second year, we received what? Interest. In the third year, we received what? Interest. In the fourth year, we received what? Interest. In the fifth year, we received what? Interest plus redemption value. Correct? So in the first 4 years, we received what? Interest. Return on that investment, called as interest here. At the end of the fifth year, along with the return on investment, we will receive what? Redemption value also. We will receive what? Redemption value also. So those are considered here under amount received column, and this amount required to be reduced. So here opening balance plus interest income is the total amount to be received from the company minus amount received, then we get what? Closing balance. Then we get what? Closing balance. And this amount received is calculated based on what? Coupon rate. Based on what? Coupon rate. Here effective rate of interest is provided based on market. Based on market. But here the amount received means regularly every year we have to calculate what? Interest. That interest is calculated based on coupon rate. Interest is calculated based on what? Coupon rate. But remember, coupon rate is always applied on the face value or par value. Coupon rate is always applied on the face value or par value, but Effective rate of interest is always applied on the investment, means on this amount. Effective rate of interest is always applied on the investment. And here the amount of closing balance is nothing but carrying amount. So required to be shown in statement of financial position on asset side. To be shown in statement of financial position on asset side. Carrying amount required to be shown in statement of financial position on asset side. This is about what? Amortized cost table, and subsequent recognition is done as per table, means this is the format of the table. This closing balance is nothing but carrying amount. So at this price only subsequently we have to recognize that financial asset. Okay, so this is what amortized table as per amortized cost. So we consider what? Year, opening balance, interest income at the effective rate of interest minus amount received equal to closing balance. Equal to what? Closing balance. So this is the one. Okay. So coming to the first one, screen visibility undamma clear ga?
Yes, sir.
Coming to the first one, a company invests $5,000 in 10% loan notes. In 10% loan notes, and the loan notes are repayable at a premium after 3 years. Premium after 3 years, and effective rate of interest is 12%. Company intends to collect the contractual cash flows, which consist of solely repayment of interest and capital, and have therefore chosen to record the financial asset at what? Amortized cost. At what? Amortized cost. What will be shown in the statement of profit and loss and statement of financial position for the financial asset for the year 1 to 3. For the year 1 to 3. Okay. So for the year 1 to 3. So here, so which approach he followed here? Financial asset at amortized cost. Financial asset at amortized cost. Then here we require to show the respected financial asset in the statement of financial position and amount required to be shown in statement of profit and loss. And before that, first we draft the amortization table, amortized cost table. So here opening balance and interest income at the rate effective rate of interest and amount received, not the, so amount received closing balance. Closing balance. So we have to consider what opening balance plus interest income minus amount received is equal to closing balance. So total how many years? What is the life of the loan notes here? 3 years. So then 1, 2, 3. And in case of amortized cost approach, an instrument or investment is recognized at what cost? Purchase price plus transaction cost, if any. Correct? Purchase price plus transaction cost. Here we have only purchase price. So $5,000 invested in the 10% loan notes. $5,000 invested in 10% loan notes. So means purchased cost is, but there is no transaction cost specified. So opening balance is how much? 5,000. And what is the rate of effective rate of interest? 12%. Effective rate of interest is 12%. And income, what is the regular rate of interest? 10%. This is what coupon rate. This is what coupon rate. So 5,000 interest income is always calculated at effective rate of interest at 12%. 5,000 into 12%. Nothing but what? 600. 600. And amount received. In the first, second and third year, we received what? Interest at coupon rate. At the end of the third year, along with coupon interest, we received what? Redemption value also. Correct? That is generally happening in case of what? Debt instrument. So that income received from the on the loan notes generally done at coupon rate. Coupon rate here is 10%. So that coupon rate is always applied on the face value. Here the face value of the respective loan notes is also 5,000. In this problem, so if you observe, in this problem, the amount invested and face value both are same. Amount invested and face value both are same. So 10% of 5,000, nothing but what? 500. Then what is the closing balance? 5,000 plus 600 minus 500, 5,100 is the closing balance. 5,100 is the closing balance. Then for second year, 5,100 is there. Then interest income is calculated at 12% effective rate of interest. It is always applied on the total value. 5,100 into 12%. How much?
612.
612. And but income is always calculated. Coupon rate is always applied on face value. 10% is applied on what is the face value of the investment here? 5,000. 5,000 into 10%. How much? 500. So, entamo 5212. Then 5212. Plus what is the effective rate of interest? 12%. 5212 into 12%.
625.44.
Just 625. Okay, 625. And so here the total amount received is nothing but what? This total amount required to be received, correct? Because at the after completion of the 3 years, the closing balance is equal to what? 0. No more it will continue, because the life of the respected loan note is how many years? 3 years only. So the total amount will be received at the end of the third year. Nothing but what? 5,212 plus 625 is nothing but 5,837. 5,837 will be received at the end of the year. So, but here remember, in this 5,837, 500 is the coupon rate and then nothing but what? Interest. And the remaining is the redemption value. So 500 is the coupon rate, remaining is redemption. Remaining what? 5,337 is the redemption value. Correct? Then what is the total amount we received? So 6,837. 6,000, correct? 6,837 less initial investment. Then tell me, what is the initial investment?
5,000.
5,000. Then what is the difference amount? Correct? 1,837. Shall we say it as interest income? Okay, now shall we consider that 1,837 as an interest income? If you calculate, if you total these three interest income, then how much amount is there?
1837.
1837. Correct? In this way you can check the answer. Clear?
Yes, sir.
Then here, what is the accounting treatment? Journal entries. For example, for year 1, we purchase the investment at the beginning of the year. Then we write what? Debit investment in loan notes. Account 5,000. Credit bank account 5,000. This is what? Investment purchased. Then second one, at the end of the year we recognize the income. How to recognize? Based on effective rate. Then based on effective rate, and that will be added to the cost of the investment. Then we have to write debit investment account, credit interest income account. What is the interest for the first year? 600 at effective rate. So then 600. This is the actual income to be recognized. But how much amount we received? Amount received how much? 500. Correct? Then we have to write debit bank account, credit investment in loan note account. So how much? 500. How much? 500. Is it clear, everyone? Everyone please respond once.
Clear, sir.
What about others? Okay, so this is the one. And in the question they ask how to show it in statement of financial position for the financial asset for the year 1, 2, 3. Okay, then I think you know the definition for non-current asset and current asset. right? Non-current asset and current asset. Okay, so in the first year, we show this 5100 as a non-current asset, because this amount is going to be received after 1 year, not within 1 year. At the end of the first year, we have to show this 5100 in the balance sheet at the end of the first year. But this amount not recognized within 1 year, means within at the end of the second year. This will be recovered at the end of the third year only. Nothing but more than 1 year is there. More than 1 year. So that's why we classify it as a non-current asset. But coming to the second one, 5212. This 5212 is the balance to be shown at the end of the second year. At the end of the second year. Then tell me how many years it will take to recover this amount, 5212? 1 year or more than 1 year?
1 year.
So within 1 year, correct? Then we classify it under what? Current asset. We classify it under what? Current asset. Then second one, what amounts will be shown in statement of profit and loss? What amounts to be shown in statement of profit and loss? Okay, in case of statement of profit and loss, for the first year, we have to show the interest income of 600, and in the second year, again we have to show the interest income. What is the interest income of the second year? 612. 612. In the third year, we have to show the interest income 625. We have to show the interest income 625. Clear? Because fair value gain or loss, fair value gain or loss is not applied in case of amortized cost. Is not applied in case of what? Amortized cost. If you remember. Okay now. So it clearly stated the fair value gain or loss is not applied in case of amortized cost, but in case of fair value through the other comprehensive income, we show it under OCI. In case of fair value through the P&L, we show it under statement of profit and loss. Okay now.
Yes, sir.
So this is the one. This is the problem relating to the financial asset of debt investment. Then coming to the second one, a company invested in 10,000 shares of listed company in November 2007 at cost of 4.2 per share. At 31st December 2007, the shares have a market value of 4.9. Prepare extracts from the statement of profit and loss for the year ended 31st December 2007 and statement of financial position as at that date. As at that date. Then tell me, first of all, is it an equity investment or debt investment? Fast ga. Equity investment or debt investment?
Equity, sir.
This is what equity investment. And in case of equity investment, which approach we follow here? Fair value through P&L or fair value through OCI? Which approach we followed? Fair value through P&L or fair value through OCI?
Fair value through OCI.
Fair value through?
OCI.
Is there any specification regarding the alternative approach or recognize the fair value through OCI like these words? So clearly stated, if nothing was mentioned in the problem regarding the treatment of the respected transaction, then we follow the default approach. What is the default approach relating to the equity instrument?
Fair value through P&L.
And remember, in case of debt instrument also, default approach is nothing but what? Fair value through P&L amma. In case of debt instrument or in case of equity instrument, the default approach is always nothing but fair value through P&L. Then in case of fair value through P&L, first, what is the initial cost? What is the initial cost here? Then respond everyone. 10,000 into what is the purchase price? 4.2. 10,000 into 4.2 is nothing but
42,000.
42,000. And is there any transaction cost?
No.
No transaction cost is there. Then, so, and even if there is a transaction cost, we don't consider, because we follow the default approach, right? Then what is the fair value on 31st December?
4.90.
So 4.90 into how many shares are there? 10,000. 4.9 into 10,000. 49,000 is there. Is it a fair value gain or fair value loss?
Gain 7,000.
Gain. How much amount? 7,000. Then we transfer that $7,000 to which account? Other comprehensive income or P&L? P&L. So in case of statement of profit and loss, so fair value gain, so it is shown as 7,000. Shown as 7,000. And in case of statement of financial position, so under the head, so non-current, sorry, it is a short-term element, is right, short-term purpose, because we assumed it as fair value through P&L, means those are held for trading purpose. So under the head current assets, we have to show the financial asset at its fair value, nothing but 4.9 into 10,000. How much amount is there? 49,000. How much amount is there? 49,000. Clear everyone?
Yes, sir.
And what about others?
Yes, sir.
Then everyone do the third problem. This is what fair value through the fair value relating to debt instruments. Then coming to the next question, fifth one. So on 1st January 2005, Bland bought a $10,000 6% bond for 9,000, incurring acquisition cost of 140. What is one by acquisition cost here?
Transaction cost.
So transaction cost, acquisition cost is nothing but what? Transaction cost. And interest is received annually in arrears, and bond will be redeemed at premium of 500 over its nominal value on 31st December 2007. The effective rate of interest is 11%. Fair value of the bond was as follows. On 31st December 2005 to 2006, 11,000, 10,400. Show how the bond will be accounted for over 3 years period. If Bland planned to hold the bond until the redemption date, Bland may sell the bond if the possibility of an investment with higher return arises. Then tell me, in the first case A, in the case A, so which method we follow? Amortization cost, fair